There's a number that's been flashing on my screen lately, and it's made sleep a little harder to come by. Silver is trading at $86 an ounce. Let that actually sink in. Not some inflation-adjusted chart, not a retroactive calculation from the 1970s, not a technical footnote. This is a level silver has never reached in modern market history. But the price itself isn't the most important part. What matters far more is what's happening underneath the surface. Because if you understand how futures exchanges really work, how clearinghouses manage risk, and how regulators react when stress starts showing up in the financial plumbing, you'll see something most people are missing. We're drifting toward one of the most dangerous moments the silver market has faced since 1980. Quietly, methodically, almost entirely outside the mainstream spotlight. Just 3 weeks ago, the CME group pulled a very familiar lever. They raised margin requirements on silver futures. Not once, not twice, 3 times in less than a month. That alone tells you something is wrong. Exchanges don't do that unless volatility is accelerating and risk managers are getting nervous. Today is Sunday, January 12th, 2026, and I want to walk you through what the playbook looks like if silver pushes beyond $95. This isn't about predicting tomorrow's price tick. It's about understanding what happens when the system gets pushed into a corner. I'm going to show you how the rules actually work, what history tells us, and why this time even a trading halt wouldn't solve the real problem. Before we go any further, you need to understand what just happened behind the scenes. On December 20th, when silver was trading around $71, the CME raised initial margin requirements for speculative silver contracts from roughly $24,000 to nearly $35,000 per contract. That's a 49% increase in less than 3 weeks. Officially, this is framed as routine risk management. Volatility rises, margins rise, textbook behavior. But timing matters. Every single margin hike coincided with silver breaking through a major resistance level. And after each hike, the price dipped briefly as leveraged traders were forced to liquidate. Then the rally resumed as if nothing happened. This isn't conspiracy territory. These numbers are published by the CME. Anyone can verify them. What the pattern tells you is simple. The exchange has been trying to slow this move using the gentlest tool it has, and it isn't working. When margins fail to cool a market, exchanges don't just shrug, they move down the list. And the next tool is far more dramatic. Before I explain that, a quick note for viewers who want to go deeper than surface level price commentary. I've put together a short educational guide called the Silver Insider Toolkit. It breaks down the warning signs that appear inside the physical silver market before major repricing events, inventory shifts, futures curve behavior, delivery stress, policy changes. It's the same framework I'm using here, and it's linked in the description. Now let me be very clear about what I am and am not saying. I'm not claiming the CME is about to halt silver trading tomorrow. I don't have inside information. What I am doing is analyzing publicly available rules, historical exchange behavior, and current positioning data to outline what could happen if this rally continues. The CME has emergency authority under its rulebook to halt trading if price movements threaten the financial integrity of clearing members. That authority is spelled out plainly. It gives the exchange broad discretion to pause trading when volatility becomes a systemic risk. How do they decide when that line is crossed? They look at mark-to-market losses. They look at margin adequacy. They look at whether clearing members, the banks and brokers guaranteeing all trades, can absorb those losses without failing. And when the losses become too large, they intervene. So the real question isn't whether the CME can halt trading. They absolutely can. The question is at what price level the losses become intolerable. Let's talk about exposure. The most recent commitments of traders report shows that the producer, merchant, processor, and user category, which includes bullion banks, holds a net short position of roughly 289 million ounces of silver. Not all of that is speculative. Some of it is legitimate hedging by miners and industrial users. But independent analysts estimate that somewhere between 100 and 150 million ounces represent unhedged or lightly hedged positions held by bullion banks acting as market makers. Let's split the difference and call it 125 million ounces. If those shorts were entered at an average price of $65, which is reasonable given last year's range, then at today's $86 price, the unrealized loss is about $21 per ounce. Multiply that out, and you're looking at roughly $2.6 billion in losses. That's uncomfortable, but manageable. But markets don't stop moving just because losses are manageable. At $95 silver, the loss per ounce jumps to $30. That's $3.75 billion. At 105, it's $5 billion. At 120, you're approaching $7 billion. And here's the part most people miss. Those numbers assume the short position stays static. The data suggests it hasn't. Commercial shorts have been adding to positions as silver rallies, trying to cap price action. If the true unhedged exposure is closer to 250 million ounces, those losses double: 7.5 billion at 95, 10 billion at 105, nearly 14 billion at 120. At that point, you're no longer talking about inconvenience. You're talking about existential risk for individual institutions. And that is exactly the scenario clearinghouses exist to prevent. Based on the recent margin hike pattern and historical behavior, the pain threshold for a trading halt likely sits somewhere between $95 and $110. Not $150. Not $200. That's where systemic stress starts showing up. And silver is already at 86. This isn't theoretical. We've seen it before. In March of 2022, the London Metal Exchange halted nickel trading after a violent short squeeze sent prices from $25,000 a ton to over $100,000 in less than 2 days. A single entity faced roughly $10 billion in losses and couldn't meet margin calls. The LME shut the market for 8 days and then did something unprecedented. They canceled trades retroactively, erasing profits to protect the shorts. The CME operates under US law, so outright trade cancellations are far less likely. The legal exposure would be enormous. But the power to halt trading is identical, and it's been used before, in crude oil in 2020 and in equity index futures during the flash crash. Here's where silver becomes truly different. Silver doesn't trade in isolation. It trades in New York, in Shanghai, in the London OTC market, in Zurich. And right now, those prices are diverging. Even if the CME halts futures trading, physical silver doesn't stop moving. Shanghai doesn't stop. OTC markets don't stop. Premiums don't vanish just because a screen freezes in Chicago. That's the structural difference this time. This isn't about calling a top or predicting chaos tomorrow morning. It's about recognizing that the usual tools are losing effectiveness. Margins aren't stopping the rally. Liquidity is thinning. Physical demand is asserting itself, and the exchange is running out of gentle options. When silver crosses certain levels, the market stops being about price discovery and starts being about risk containment. And that's when things get uncomfortable. While most people are still fixated on New York prices, the real signal is coming from the other side of the world. On the Shanghai Futures Exchange, the most active silver contract just settled near $89 an ounce. That's not noise. That's roughly a $3 premium over New York. In metals, a $3 premium is loud. Historically, Shanghai trades slightly higher than COMEX, maybe 50 cents, maybe $1. A $3 spread is not normal. It's a message. Physical silver in China is tight, and buyers are willing to pay up. And this matters more than most people realize. Price discovery doesn't exist in a vacuum. If COMEX silver dipped meaningfully while Shanghai held firm, arbitrage traders would step in instantly. They'd buy in New York, take delivery, ship east, and sell into Shanghai. That flow creates a hard floor under the paper price. Any dip gets bought aggressively, not by retail traders with opinions, but by professionals with spreadsheets and shipping contracts. Shanghai becomes a shield. Now take it one step further. If the CME halts trading, Shanghai doesn't care. London doesn't care. Price discovery just migrates east. And when COMEX reopens, it has to reopen near the global physical price, or it gets drained instantly. That's not theory. That's mechanics. The vault data confirms this process is already underway. Registered silver inventories, the metal available for immediate delivery, have fallen from roughly 168 million ounces in late November to about 123 million today. That's a drawdown of 45 million ounces in 6 weeks. The pace is accelerating. 4 million per week became 6. Now it's pushing 8 or 9. That's not linear. That's exponential. At this rate, registered inventory approaches zero by early spring. Yes, there's still eligible silver, but eligible metal isn't available unless the owner chooses to register it. And when physical tightness increases, owners become less willing, not more. Registered inventory is the pressure point, and right now, that gauge is flashing red. This is what happens when physical demand overwhelms paper supply. Exchanges can manage contracts. They cannot manufacture metal. And when physical wins, control starts slipping. So if silver pushes into the mid-90s and the CME steps in, the effects won't be neutral. Halts favor shorts, margin hikes force weak hands out, and price discovery doesn't stop. It relocates. Meanwhile, the fundamentals remain unchanged. A structural supply deficit, exploding industrial demand, slowing mine output, and accelerating global competition for real metal. This is not fear-mongering. It's mechanics. And understanding those mechanics is the difference between reacting emotionally and positioning intelligently. The next several months could redefine how the silver market works, and knowing the rules before they're enforced is the only real edge anyone has. When people talk about silver like it's just another trade, they miss the deeper shift that's already underway. This market isn't behaving like a normal commodity cycle anymore. It's behaving like a system under strain, and systems under strain don't resolve gently. They resolve abruptly, often in ways that surprise everyone watching the surface while ignoring the plumbing underneath. If you zoom out far enough, what's happening right now isn't mysterious at all. It's structural. Global mine supply hasn't meaningfully increased in years. New discoveries are scarce. Permitting timelines are longer, capital costs are higher, and many silver mines are byproducts of other metals, meaning production doesn't ramp just because silver prices rise. Supply is sluggish by design. Demand, meanwhile, is anything but. Solar capacity continues expanding at a pace few predicted. Electric vehicles, grid upgrades, medical applications, and electronics all rely on silver in ways that can't be substituted easily, and layered on top of that is a growing investment bid from people who no longer trust currencies, governments, or financial intermediaries to behave responsibly. That combination is deadly for a paper-based market structure. Futures markets work best when physical supply is abundant and confidence is high. They break down when delivery matters and confidence erodes. That's when contracts stop being promises and start being liabilities. And here's the uncomfortable truth. The futures market for silver is still many times larger than the available physical supply backing it. That mismatch is manageable when most participants roll contracts instead of standing for delivery. But when even a small percentage decide they want metal instead of cash, the math starts to fail. You don't need everyone to demand delivery. You only need enough people to stress the system. This is why the inventory drawdown matters so much. It's not just metal leaving vaults. It's a signal that trust is shifting. When holders move silver from registered to private vaults, they're saying something very clear. They don't want counterparty risk. They don't want promises. They want control. And once that mindset spreads, it's almost impossible to reverse. Now layer psychology on top of mechanics. All-time highs change behavior. They attract attention. They force re-evaluations. Institutions that ignored silver at 50 can't ignore it at 86. Portfolio managers who dismissed it as a relic are suddenly asked why they have zero exposure. Momentum traders pile in. Hedgers get squeezed. Shorts dig in deeper. The feedback loop tightens. And that's why margin hikes stop working. Well, margin hikes assume traders are over-leveraged tourists who will flee when conditions get uncomfortable. But when the bid is coming from physical demand and long-term capital, higher margins just reduce liquidity. They don't kill demand, they make price move sharper. This is where exchanges face a dilemma. Do nothing, and volatility accelerates until something breaks. Intervene too aggressively and you confirm that the market is broken. Either way, confidence takes a hit. And once confidence cracks, paper markets lose their grip. If you've been wondering why silver feels different this time, that's why. It's no longer just trading off macro narratives or rate expectations. It's responding to physical scarcity and institutional stress simultaneously. That combination is rare, and when it shows up, it tends to rewrite price levels people once thought were impossible. The most important thing to understand right now is that volatility is not a sign of failure. It's a sign of transition. Markets get volatile when they're moving from one equilibrium to another. The old price no longer works. The old assumptions no longer hold, and the system has to reprice reality in real time. That process is never smooth. If you own physical silver, this environment is uncomfortable but ultimately validating. The noise can be ignored because the thesis hasn't changed. Scarcity doesn't disappear because a futures exchange pauses trading. Industrial demand doesn't vanish because margins rise. If anything, disruption reinforces why physical ownership matters. If you're operating in paper markets, discipline matters more than conviction. Liquidity matters more than opinions. Leverage is no longer your friend. When rules can change overnight, flexibility is survival. What happens next doesn't hinge on headlines, it hinges on flows. Vault movements, delivery notices, international spreads. Those are the signals that matter now, and they're all pointing in the same direction. Silver is being repriced not because of hype, but because the old price no longer clears the market. That process is still underway.